for quite a while, there wasn't much of an incentive to solve this problem. And now there's starting to be an incentive to solve this problem.
Steve, Joe, we have heard an awful lot about the trade imbalances with China as the new administration's coming in. I think we're going to be talking about that here on Question Time a lot during the year. But I thought it'd be a good idea today, Joe, if you started by just laying out the history of the trade issue with China and yeah, and maybe later we'll go into how you try and reset that. But what's the history behind that?
Well, it goes back to the mid '90s, but I think it might help to talk about a little about history before that, even because trade is a man. Trade economics is one of the hardest topics you will run across in economics. It is incredibly difficult to uh, to predict anything, first of all, and it's incredibly difficult to even understand what's going on. So, what we're really talking about here is goods and money crossing borders. Now, borders are just lines on the globe. They don't really mean all that much, but the policies within those borders make a difference. So if you go back to, say, the gold standard back in the late 1800s or even into even Bretton Woods, which was a quasi gold standard, but back in the real gold standard days, say post Civil War um, up until well, we came off for World War One and then we went back on. But anyway, gold standard. So what happened if you ran a trade deficit? What that meant was gold flowed out of the country because you paid for things in gold. That's what international trade was settled in was essentially settled in gold. So you had a pile of gold, and if you bought more than you produced, if you ran a trade deficit or if you ran a current account deficit, more to be more accurate, gold your gold pile dwindled. So there was an obvious limit to what you could do and run a deficit for however long until your gold ran out, and then you had to do something. Okay. What did you usually do? Well, what you usually did was you devalued your currency because the idea that you're the point of a trade deficit, the source of it in some ways is an overvalued currency. Okay, that's basic stuff. So if we fast forward to Bretton Woods was a quasi gold standard. It wasn't really a gold standard. You didn't have to have gold reserves and so forth. The way that worked was the dollar was pegged to gold at a fixed rate, $35 an ounce, and all the other major economies had their currencies pegged to the dollar at a set rate. It was fixed exchange rates. So if one country had an imbalance where they were importing or exporting more, things weren't balanced, then there were mechanisms within Bretton Woods to fix that. That's why we got things like the IMF and the World Bank and Bretton Woods. Those things were designed to handle these trade flows and resolve them before they became a big problem. And the reason that that's true, by the way, is because if you go back to, say, the 1870s when Germany was the rising power after their unification, and Britain was the world power, well, Germany was eating the UK's lunch on trade, and in a sense, they were doing a lot of the same things that China ended up doing in the 1990s. They undervalued their currency, they kept it undervalued, they cheated, they by using subsidies for domestic producers, things like that. And when people say that this other country is cheating on trade, that's what they mean. That they're doing things that are designed to allow them to export more. So that's kind of a little history there. So if you go continue then into Bretton Woods, all these mechanisms were set up. Oh, I guess I should finish that thought. So you had Germany. So that essentially led or was a factor in leading to World War One. And then World War II comes along, and that was post-Depression. And during the Depression, we had trade issues again. Here in the United States, we enacted Smoot-Hawley Act in 1931, which severely raised tariffs to a very high level, and other countries retaliated by imposing tariffs on us, and world trade shrank. It made the Depression worse. I won't say, as some people have, that it created the Depression, because I'm not sure that's true. Although there's an argument to be made that maybe if you hadn't had Smoot-Hawley come along, you'd have just had a really bad recession and it would have moved on. I will say that depressions and recessions prior to that period were resolved fairly quickly. We had a depression in this country 1920, 1919, 1920, coming out of World War One, because we kind of, post World War One, we went back on the gold standard and so forth. There was a problem there. That's a problem that creates problems, and we had a deflation and a depression, but it only lasted like a year because the government didn't do anything about it. They just let it run its course. Now, we don't do that these days. We have social safety net and so forth. Back then, you didn't have a social safety net. And even in the 30s, you didn't really have much except what was enacted by Franklin Delano Roosevelt during the Depression. Anyway, the point is, these things ultimately were seen by the financial elites of the day, led by John Maynard Keynes, as a contributing factor to world wars. So obviously, you want to prevent these imbalances in trade from persisting if you can. So they set up all these mechanisms within Bretton Woods to do that. If you have a currency, if your currency is overvalued, then there would be an agreement about it would be reset, and fixed exchange rate would be adjusted to take these things into account. Okay. So what happens 1971, we come off of Bretton Woods. Actually, well, Bretton Woods ended in 1971 and closed the gold window, as they say. Nixon closed the gold window. Fixed exchange rates hung around for a little while, but they weren't sustainable. And so that finally, it really ended in about 1973. And after that, it's free floating currencies. Currencies are currency values are determined by the market. Okay, sort of, I say. Why? Well, to really have the market really truly do that and adjust in almost real time, you not only have to have free trade, you have to have free flow of capital. Money has to be able to go back and forth across borders, and that wasn't necessarily true in the early 70s. And by the way, that's part of the problem with China. It's not true today. So let's fast forward to the 90s. You get to the 90s, 1994, I think it was, China devalued the yuan. That's their currency, and they devalued it significantly. And they kept it. It was very undervalued. And when I say they devalued it, look, they have more control over their currency than we do because, again, they don't allow their citizens to move money in and out of the country at will. If we want to send money to Europe, it's no problem. We can send money to Europe. It's not a problem. But if you're Chinese and you want to send money to America, you can't do it. There are ways to get around those controls and so forth, but capital controls have a big impact. So they just devalued their currency. They said, no, the yuan's worth this now. And at the time, it was really, I think, just mostly a peg against the dollar. I don't think it was really a basket of currencies. That came later. But the bottom line is the yuan was undervalued. And so that's how they started to jumpstart their economy through exports, was by keeping their currency undervalued. And they did that for over a decade before it finally started to adjust after the financial crisis in 2008. And they did let it rise somewhat after that, but it never got to probably where it should have been. And now it's going in the opposite direction again. So the history is that they cheated. And so I would applaud in some ways. I would applaud the Trump administration for coming along in 2016, I guess was his first, or 17, I guess was his first year, and saying, hey, look, these guys, they didn't play fair. And so we're going to do something about it. We're going to impose tariffs. Well, the problem is that the tariffs don't solve the problem. Ultimately, this is about currencies. And what happens is now we think about what happened in the first term. He didn't impose tariffs until 2018. But ultimately, what it does is it makes the dollar go up and it makes the yuan go down. Except the yuan can't go down as much as it should because China doesn't let it because of capital controls. So even that did not solve the problem, but the problem was mitigated. The tariffs were mitigated by China's devaluation of the yuan. So the bottom line is that, tariffs are a way to punish another country, but ultimately, and this is true of all cases, ultimately in some ways, actually, I want to back up a second. Currencies in a free floating currencies with absolutely no capital controls would adjust in real time. But I can show you, I can prove to you that China doesn't let that happen by looking at the end of the 1990s. And here's how we do that. Ultimately, a trade imbalance, a trade deficit is a mismatch between investment and savings. You don't have enough, if a country doesn't have enough savings to fund their investment, they have to get it from outside the country. And the way you do that is by running a trade deficit. And it's not like you do it intentionally, it just happens. And so the investment we need in our economy because we run budget deficits comes from overseas. Okay. So what about it? What if we balance the budget? Well, you know what? We did in the late 1990s and Bill Clinton's last year in office. We actually ran a surplus here and we still had a trade deficit. And that's how we know that China was cooking the books. That's how we know that China's currency was undervalued dramatically because we continued to run a trade deficit even after we eliminated the cause of the problem. So now that's not, I will say that's not exact because when I say surplus, that means a primary surplus, which means it excludes the interest on the debt. So it wasn't maybe actually a surplus, but it's pretty damn close. The point is that our trade deficit didn't really improve all that much, even though we fixed the budget deficit. And that's because China wasn't playing fair. So again, I'll applaud the Trump administration for coming along and identifying the problem, but we have to have a real way to fix it. And that's where we're really kind of coming up short. Tariffs are not going to get the job done. And even balancing the budget, which would be great, by the way, is not going to completely solve the problem either, unless China agrees to cooperate. And that's what this really is all about. It needs to be negotiated. You need to have diplomacy in order to solve these problems. And that's where we're coming up short. We don't have the diplomacy. Now, look, I will say this. It's very interesting. Donald Trump comes in, he campaigns on, hey, we're going to put 60% tariffs on China. And he's come into office here and he really hasn't talked much about China. And when he has, he's talked about a 10% tariff, not 60. So I'm not sure exactly. And this is, what we talked about yesterday. Trump's unpredictable. You don't know what he's going to do. And so I don't really know what's going on there. Is he going to go and negotiate with Xi and come up with some agreement? I don't know. Is it because of TikTok? Is that part of the issue? Is that, is that affecting his judgment on tariffs? I don't know. But I know that tariffs by themselves will not solve the problem. And that history there, it's not perfect. I didn't get up this morning ready to give a lecture. But and there's probably some things I glossed over there that would, make it clearer, but that's the basics of it. It's not an easy problem to solve. I'll say that.
Steve, as I'm listening to Joe, there's another piece of that I wonder if it fits in when China was allowed to come into the World Trade Organization. I mean, they're already cheating. Joe said that. Did that help or did it hurt?
Yeah, I think that's an interesting question because I think that goes to partly why for quite a while there wasn't much of an incentive to solve this problem. And now there's starting to be an incentive to solve this problem. So for quite a while, a lot of the more powerful interests in the world, not just us, Europe and whatnot, looked at China as a place where, those who had, massive amounts of capital could go and get goods produced very, very cheaply. I'm sitting in Silicon Valley. It's a big model of Silicon Valley to really outsource and offshore everything you possibly can and just have as much high value concentrated in the company so you can make as much money. It's not the old General Motors model from like, the 50s and the 60s, where the secretaries and, everybody else can do well. We developed a model that was very attractive for those controlling capital where they could get very cheap labor production. And then you also had dangling the carrot of this emerging Chinese middle class that you're going to be able to export to. And the Europeans are still working with that model, even though it's pretty defunct at this point, that they would have that emerging middle class. So, there was a big incentive for those in power to work with China and to allow the cheating because they benefit on these other terms. The future potential of was called going to be the biggest market in the world to export to, as well as that very cheap labor. Didn't help the Rust Belt out or whatnot, but you know what? They don't have a ton of capital and they don't have lobbyists. So, oh well. Now that's changed. That has really changed at this point. And a lot of people now are looking back at that entry into the World Trade Organization saying it was a mistake, that we should never have ever really deindustrialized, brought them in. Well, they're saying it now for a few reasons, but one is that that story of that emerging Chinese middle class that was going to be this vibrant market for the West to export to. that would solve these trade imbalances, as well as the defunct idea that China was going to, over time with trade, become a model democracy that works in the world system and doesn't cheat. Those are gone. Nobody's really seriously arguing either of those. In fact, the Chinese youth right now have a slogan of "Let it rot," and they're looking at youth unemployment of around 20%. You've got one of the biggest real estate bubble, probably the biggest real estate bubble ever, trying to unwind. Acts a little bit differently under state control. And you've got a president who's throwing out the slogan of "Eat bitterness." Um, this is no longer a story about the future growing dynamic middle class. Um, so, people are not so enamored with that. You can take a look at what's happening with the European auto exports into China. Um, and then on the other hand, you've got real demographic problems. You've got the Chinese population shrinking. You've got estimates that are not crazy by any means, saying that by the end of the century, they'll have like half the population they have. You've seen labor costs going up. So those twin forces that kind of kept people from even wanting to deal with this issue, or kept, allowed them to look the other way, and gave rise to I would argue, the Bernie Sanders and the Donald Trumps and a populist movement. Um, those aren't there so much. So now we're starting to seriously talk about how do you deal with this problem. And I think, the people in power are starting to seriously look at all the issues Joe brought up. And I think we'll talk about this in the future because, as Joe alluded to, it ain't so simple to fix, especially since we've integrated the global economy with China and you can't disentangle overnight. There's a lot of issues here we won't even get into. But I would say, to your question, yeah, the WTO was a big deal in terms of, we had reasons why we did that. A lot of powerful vested people had, I'd say, those two main drivers to do it. And now those two main drivers really aren't in place. And not just us, but many countries are starting to look at reevaluating those trade imbalances with China, now that it isn't looked at so much as an advantage from the controllers of capital outside of China, that did so well with that previous model, and now it's not working for them.
Well, Joe, that was the question I was going to ask you. Is it just the United States, or is this an issue that is global? Is it Europe? Is it EU? Is it pretty much everybody among the developed nations?
Oh yeah, it actually is. I mean, that's why Europe's putting big tariffs on electric China or Chinese electric cars. The fact that they undervalue the yuan. Now, look, let's be honest. The yuan is pegged to a basket of currencies, but China decides what the basket is. The biggest weight in that basket is the dollar. So we have the biggest impact, or it has the biggest impact on us. But look, I would just go back really quick to one thing that Steve said. This idea of an emerging middle class. And by the way, going into the WTO was about what Steve also said about trying to get China to be more democratic and be nicer to their own people, which that was his theory. That if because there's this old saying about if goods don't cross borders, armies will. And so the idea was, hey, let's make China more democratic, and by doing that, we can do it via trade. That's why we let them in the WTO to begin with. Yeah, it didn't work. But here's the more interesting thing to me. Here's was kind of an irony in a way. The emerging middle class in China, why didn't it ever become a big deal? Why were we not able to crack that market? Well, we didn't crack that market because the middle class in China doesn't consume. They save almost 50% of what they make. Why? Here's the irony part. We're talking about a communist country, right? Communist country, you would think that we all think, oh, communist country, that means that you're covered from cradle to grave. The government will take care of you in a communist society. Yeah, the reason they save so much, they don't have a social safety net like we do. We have the social safety net, not the communist. It's kind of crazy in a way. It's like, I mean, I think if you were to, fall into some situation in China, if you're a Chinese citizen and you don't have a job or whatever, I suppose you get fed, but I don't think you get a lot else. Anyway, I just find that really, really ironic that we're looking at this communist country and they save so much because they're worried about the future because they don't think the government will take care of them. That communist thing ain't working out for them. So, and it's not going to. Anyway, look, that's all I can really add. I don't know how this is going to come out. I hope, my hope is that we do get over there and have some diplomacy, some negotiation to try to figure this out and try to move ahead. I don't know if you can trust them. I don't know. We'll see how that plays out. In the meantime, I think everybody in the world is planning on China being a little more isolated. And listen, we talked about this in one of our papers too that we wrote. We think the world's going to break up into these trading blocks, and China will be one of them. But they're not going to trade as much with the West. They're going to trade more with the global South and emerging markets and so forth. So I think that's what's happening, and I think that's also, by the way, why Trump is focused on Canada and Mexico. He wants to renegotiate the trade agreement that he did in his first term, and he wants to build this North American trading bloc. And I would argue it needs to include South America too. I think we need to have an America's trading bloc, but I'm not making those decisions right now. But I'll give you one prediction. There will be a deal, maybe probably free trade. There will be a free trade deal between the United States and a South American country fairly soon. And by fairly soon, I mean in the first 2 years of his term. And the country will be Argentina. Wait and see.
We'll be talking a lot more about China during 2025, so stick with us and be sure you tell us what you think about resetting trade with China in the comments section down below.